Hi everybody, this is Alan Ellman, the Blue Collar Investor, with today's covered call writing question of the day. And today's question comes from Jimmy. Alan, I recall reading or hearing you say that you owned one stock for about 2 years and sold options during that time. Can you summarize the circumstances under which you owned a stock for that long? Are there others which you would have held for an extended period of time, for example, longer than 1 year? Thank you. Well, Jimmy, for me, it would be extremely rare to hold a stock for that period of time because I always avoid earnings reports. Now, thinking back, because I have written over 300 articles and produced over 150 videos, so I'm not sure of the resource that you're referring to, but it very well could be the fact that for a very long period of time, I was writing options on the Qs, which tracks the NASDAQ 100, in my mother's covered call writing account. And the reason that I was using that is because the Qs, after the explosion of the dot-com bubble in the early 2000s, was a very, very reliable exchange-traded fund. So that being said, let's take a look at a chart of the Qs and see why I may have held this for such a long period of time. Now, on the screenshot in front of you, you could see a 1-year chart that I created actually in October of 2013. And this actually is pretty typical of what went on for a long period of time in the early 2000s. You could see that the price chart was uptrending, very strongly so, with confirming MACD and stochastic indicators. And that uptrend was confirmed with very strong volume, which you could see on the bottom right-hand portion of the screen. So we know that when you see a chart like this, that this security is being supported by the institutional investors, and therefore very appealing to average retail investors like us. So that being said, let's take a look at an options chain to see the kind of results we can get by selling call options on the Qs. So on the screenshot in front of you now, you could see, and this is a 1-month options chain for the Qs, and you could see at the time the price was $82.40, and I looked at the $83 out of the money call, which generated $99 per contract on a cost basis of $82.40, so we could generate a 1-month return of 1.2%, which annualizes out to better than a 14% return, which is a very nice return for a conservative approach to an already conservative strategy, covered call writing. Now, one of the things that I stress all the time in the BCI methodology is that when you're using individual stocks, which is what I use in my own accounts, you must avoid earnings reports. And the reason for that is that a disappointing earnings report can bring down the price of the stock and wipe out your entire month's profits on covered call writing. So what we do is we show our premium members, and we stress to them in our reports that we produce for them weekly, and make sure that they don't make a mistake accidentally writing a call on a stock that's about to report. So let's take a look at a screenshot on what such a report might look like. And as you could see in front of you right now, if you look at the top right portion of the screen, all those stocks in the gold rows are reporting in the current options contract month, and we highlight that in gold, in addition to actually reporting the projected earnings reports date also. So it's almost impossible for a premium member to accidentally write a call on a stock that's reporting. Now, once the earnings report passes and it's a good report, then you're free to write the call. So you get the best of both worlds. You avoid the possibility of a negative report, but if the report is positive once it passes, you can then generate income on that particular stock. Now, there have been a couple of cases where I actually did hold a stock for a long period of time. And two stocks that come to mind are Cisco and Apple. And back in the early 2000s, these two stocks had a tendency to positively report. And so every time a report came out, the price of the stock would go up. So what I did in those two cases was I wrote calls on those two stocks, except for the month when the report came out, but I still held on to the stock, hoping to benefit from a positive report. Once those reports passed, I then wrote the calls, getting the best of both worlds. Share appreciation from a positive report, and then option profit from selling the covered call option. So Jimmy, there you have it. To summarize, probably referencing an exchange-traded fund where I didn't have to worry about earnings report, and most likely it was the Qs because I did hold that for a very long period of time and still do on and off in my mom's account. And exceptions to the stock rule would be stocks like Cisco and Apple, and that was years ago. And so right now, basically my portfolio turns over 20 to 80% a month because of earnings reports. Thanks so much, Jimmy, for that great question. Thanks to all of you out there for watching this video. I hope you found it useful. And as always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.